What is the real problem with health insurance in the United States? Is it greedy companies trying to deliberately screw over consumers? Is it a shortage of government interventions to protect participants? Should your employment be tied to whether you have coverage? Today, we are going to dive into these questions, and the results may surprise you. Elements from these questions are all part of the problems and the solutions. The bottom line, though, is that the actual problem with health insurance companies is that they don't make enough money. It's a surprising take, but in this video, we are going to explain why.
You're denying my claim? I don't understand. I have full coverage.
I'm sorry, Mrs. Hoganson, but our liability is spelled out.
I've always wondered what it felt like for defense lawyers who had to represent someone who was objectively unlikable. It was never a question of why those attorneys did it. It was money in many cases, and the profit motive will make a reappearance later in this video. But in others, especially those that rely on public defenders, it's the principle that everyone is entitled to representation. I got a glimpse into this feeling a couple weeks ago when my wife and I were on an evening walk and got embroiled in a debate over the health insurance industry. I found myself as the defender of what can certainly be considered one of the most universally hated forms of business. Prior to this debate, I had never truly given the issue deep thought. It's fair to say that I'm an ardent capitalist and proponent of limited government. Therefore, in the past, when the topic of health insurance would come up, I'd usually default to the riff on Winston Churchill's famous quote about democracy, that private health insurance is the worst form of healthcare, except for all others. However, during this debate, I found myself making the argument that one of the largest problems with the health insurance industry is actually that they don't make enough money.
You smell that? What is that? Money. Okay. I smell money.
Before we can dive directly into the argument, we must understand several key concepts and terms. I will also caveat that if you either don't believe in free markets and capitalism, or think that the provision of healthcare should be a function of government, then this may not be the video for you, but I hope you stick around anyway. Firstly, let's start off with an important term: profit motive. It's simply defined as the desire for financial gain as an incentive. This is a motivating force for individuals and companies that aligns with human nature in that people want the most return for the least amount of work. It is, as Adam Smith described, quote, "Not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own interest. We address ourselves not to their humanity, but to their self-love, and never talk to them of our own necessities, but of their advantages." What this means in practice is that in a free market, if there is an unmet need or an opportunity for a large payoff, then people, or people organized through corporations, will move themselves or their capital to take advantage of that opportunity. If there are limited profit margins or returns in one business, then capital and labor will flow to other, more lucrative areas.
This is it. I'm going over the top right here. I'm buying the market right here, right now, because I know more than anybody.
This is true of health insurance companies, which are just collections of people who have invested their capital and labor for the provision of those services in the expectation of some financial return. However, this industry does not operate as a truly free marketplace. It is subject to overregulation, price controls, and dislocations due to tax policies that distort normal market efficiencies and therefore prevent benefits to the customers that would occur if markets were allowed to operate normally.
I understand about 20% of what goes on around here.
One of the key points that needs to be understood is the relationship between employment and health insurance in the United States. Half the country receives their health insurance as a workplace benefit. The reason behind this has to do with price controls that were implemented on wages during World War II. As companies were unable to raise salaries to attract workers, they turned to offering health insurance as an alternate form of compensation. This became further entrenched as the government determined employers could deduct these insurance costs from their taxes and would also not be a taxable benefit for employees either.
And please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
Next, we must examine how health insurance companies make money. Within each of these companies, there are oftentimes numerous business lines. An example would be CVS, which operates a ubiquitous physical convenience store and pharmacy chain within the United States, but also is an insurance provider as well. Part of the reason for this is due to the need to generate revenues and profits from other sources to supplement the constraints on their insurance business. However, for the purposes of this analysis, we will look simply at the basic business of the provision of health insurance services. It's really quite simplistic. Individuals or groups of individuals represented by their employer pay monthly premiums to the health insurance company. Then, as these people engage with healthcare services that are covered, the insurer pays out claims to these healthcare providers. The gross profit from this is simply the quotient of dividing the claims paid out by the premium received. In industry speak, it is called the medical loss ratio, or MLR. This is where the majority of healthcare insurance revenues and profits come from. From these gross profits are then deducted the operating expenses of the company that can include salaries, office space, software, advertising, etc. And then finally, that remainder is then taxed. The problem that arises, though, is that government regulation, specifically the Affordable Care Act known as Obamacare, placed price controls on this industry by capping the medical loss ratio.
If you like the plan you have, you can keep it. If you like your plan and you like your doctor, you won't have to do a thing. You keep your plan. If you like your health care plan, you'll be able to keep your health care plan. If you've got health insurance, you can keep it.
The law capped the MLR at 85%, meaning that insurers had to pay out 85% of the premiums received on claims, and if they didn't, then they had to reimburse premiums to the customers. In theory, this sounds great. In practice, it creates a system of perverse incentives for the companies currently operating in the space. The company's goal is still the profit motive and the drive to maximize that. However, because of the MLR cap, they aren't incentivized to reduce the cost of healthcare services side of the equation because there are exponentially diminishing returns up to the cap. Company officers are then only able to generate further returns in ways that are deleterious to customers but still in compliance with the law. One of the easiest ways is to try to cut administrative costs on the company's side. This can include everything from reducing customer service centers and representatives to installing automated systems to process claims that may erroneously deny some requests. Unfortunately, this will only get you so far, though.
That it could be possible to fire 500,000. I thought maybe from one of the smaller companies where no one would notice, like one of the cab companies.
Fire 1 million.
Ostensibly, the companies should try to negotiate with healthcare service providers to keep the reimbursement costs down as well. Yet, the limited ability to expand profit margins beyond a cap means there is little juice to be squeezed out here for the benefit of the corporation. Further, the insurance company more or less has a de facto monopoly through being a tax-advantaged workplace benefit and employers offering only a single option. Customers are then disadvantaged from trying to purchase health insurance in a public marketplace, which causes that market to atrophy, leading to price and service inefficiencies. This warped system of incentives means that the health insurance companies are easily able to push through costs to the end consumer when the healthcare service providers want to raise their costs. This ends up being great for the insurance companies. If, for example, the cost of care rises by 20% and the insurance companies raise their premiums 20%, then their overall profits rise by 20% as well, even though the medical loss ratio hasn't changed. For the insurer, this is a much easier and more financially rewarding path than trying to negotiate with providers for perhaps only 0.25% of additional margin.
This has been enormously profitable, as I imagine you noticed.
I have.
Now, you will often hear that health insurers make billions of dollars in profit, and that is in fact true. The problem is, it's a meaningless statistic without understanding the scale of the overall industry. And when you adjust to what percentage of net profit margin insurers make, the picture changes dramatically. Take United Health, one of the largest publicly traded health insurance companies. The company made $25 billion of profit in 2024, and yet it was only a 6.3% net profit margin, which has been around its average for the last several years.
The foundation is funded by the profits of Wayne Enterprises. There have to be some.
It's actually in percentage terms, not a very profitable business. This is important when we think back to the principle of profit motive, where investment flows to where high profit margin will be achieved. When you look at other opportunities, even in large established companies like NVIDIA, which has a 56% net profit margin, or Microsoft, which has a 36% margin, the relative disparity becomes clear. Why would capital try to flow to a place where it gets a sixth or less of the return?
What is this multi-billion-dollar industry missing?
Multi-billion dollars.
This means that there is no incentive for new players to enter the health insurance marketplace in order to take a piece of the profit by providing a better service. The price controls and other tax and policy subsidies motivating employer-provided insurance have removed competition from the industry. Competition is good because it spurs companies to provide better and lower cost services in order to take market share from the existing players. When there is no money to be gained, then no one tries to do it. We can look at a very comparable industry to see how this might play out. In this case, the auto insurance industry. Now, no one likes any form of insurance, to include auto, but the average person understands its utility. Yet, public hate towards health insurance is a magnitude of order greater. This is because auto insurance operates in a competitive marketplace. Auto insurance companies are still trying to maximize both profits and market share, while their customers are trying to get the most benefits for the lowest cost.
I'm a teenage girl. My BFF Becky texts and says she's kissed Johnny. I like Johnny. Nipsies. And if you've got cut rate insurance, you could be paying for this yourself.
You can see this disparity in competitiveness and the amount of advertising done in the two industries to try to attract new customers. Auto insurance ads are ubiquitous, but I can't say I've ever seen an ad for a health insurer. It's because they don't need to. Regulation, law, and tax policy capture have incentivized them to try to maximize profits in unnatural ways to the detriment of the end customer. Now, imagine a scenario in which health insurance operated under the same free market framework with no price controls capping potential profit. There would now be an incentive to try to push back against healthcare providers trying to raise prices in order for the company to try to keep a greater profit. With larger profit margins come new players, as others want to get a piece of the action. Finally, add into this mix customers who are no longer shoehorned into employer policies due to tax policy disparities and can choose which health insurer best meets their needs and price point.
Brilliant! We're going to be rich!
The insurers would now need to lower premiums as they compete with each other to attract and retain market share. They would take part of the cost savings from negotiating with providers and pass it along to the customers with lower rates. Further, they would care more about customer satisfaction with their service and take the necessary steps to provide better customer service in order to retain those customers lest they go elsewhere. Eventually, the market reaches a point of equilibrium through competition, where the costs for both health insurance and the healthcare services most accurately reflect the actual intrinsic costs. This was all done by removing distortions created by regulation, law, tax policy, and allowing companies and people to make unfettered decisions based on greed, where they try to make or retain the most money possible.
I'd like to help you, but I can't. I'd like to tell you to take a copy of your policy to Norma Wilcox on Norma Wilcox, WIL.
There are other issues related to the provision of health insurance services that haven't been touched on here. There are proponents of government-run healthcare, and they make arguments for that. This video isn't meant to be a debate on that issue. Although, I'll say off the cuff that I have yet to see any cost-effective and efficient government program at scale. People hold up the social democracies of Europe with their government-run healthcare as an example. Yet, many of these countries are running up massive deficits to finance their social programs, or, as in the case of Germany, have, for the last few decades, been living in a surreal world where the normal decisions of trade-offs between defense and social programs haven't had to be made until recently. Additionally, there also exist questions of how to cover high-risk individuals. In a free market, insurers wouldn't want to take on these high-cost people if they can help it. I have heard several ideas of how it can be done in a balanced way. For now, though, that debate is moot, because of the twisted nature of the health insurance market as it currently exists. Finally, debates about pharmacy benefits managers, or PBMs, have arisen of late, but these are a symptom of trying to make up for the price controls in the primary business. Therefore, I say unleash the power of free markets to the benefit of customers by allowing health insurance companies to make more money.
That greed, for lack of a better word, is good. Greed is right.
Thank you for watching and honoring me with your time. Please like, subscribe, and sign up for alerts if you want to see more content like this.
Are you saying we shouldn't help our customers?
The law requires that I answer no.
We're supposed to help people.
We're supposed to help our people, starting with our stockholders, Bob. Who's helping them out?